Morning and welcome to a lender webinar with AdviceWise. Today we've got Standard Life Home Finance and we've got Sanjay, Gadhia, National Sales Manager, who you all hopefully know and love from across the sector. You've certainly seen him on the space, on the circuit. I'll hand you over to Sanjay in a minute, but before I do, just to let you know, a little bit of housekeeping as usual with these virtual sessions. Conscious of the experience for everyone else, so constantly looking at your mic. If you can keep it muted for the purposes of today's call. That doesn't mean you can't ask questions. I'm sure Sanjay doesn't mind you unmuting to ask questions here and there, but if you can utilize the chat box, that does help a lot as well. So if you just go to the bottom of your screen, type in any chat there, and the team will pick it up and prompt the questions throughout. Cameras, if you're struggling with internet signal or anything like that, you can always turn those off and it tends to help, but it's always nice to see your lovely faces in the background when we're doing this as well. This session is being recorded. It will appear on our upskill part of our AdviceWise website, so you can watch it back retrospectively, and you'll also be getting your CPD certificates via email over the next few days. It's likely going to be before the weekend when that gets put out there. So expect an email to you over the next few days, and you can download your CPT certificates and a link to register for future sessions going forward. Just going through other housekeeping bits, questions and engagement is incredibly valuable. It makes life a lot easier for the speakers and myself. So please do have some possible case studies, ideas, queries for Sanjay. I'm sure he'll be, and he will welcome that. If you haven't already registered for AdviceWise, so yes, this is our hosted webinar, but we advertise this publicly. Please do. If you haven't already booked a demonstration with us to see the full capability and what's new on the AdviceWise platform, please also do that as well. As usual, when I'm hosting these sessions, I like to do a little bit of a market update, a very high level. So for the purposes of the recording, these are rates that are live as of the first week of March 2024. So the lowest equity release rate, the monthly equivalent rate in the market at the moment is a 5.38, and that's with the lovely Standard Life Home Finance, as I'm sure you're all seeing that very fluid across sourcing platforms at the moment. The gilt rate as of about 10 minutes ago stands at 4.279, so it has moved ever so slightly downwards into the 4.2s, but in the bigger picture, the last month or so, it's certainly sat in and around that area. But stability is not a bad thing from my perspective. We all know on an increasing market, clients tend to sit on their hands, and on a reducing market, even further, right? They're waiting for cheaper rates to come through. So watch this space. Hopefully that drives a little bit of engagement, which we are certainly seeing it do so at the front end. When it comes to inflation, it's still 4.2. It's sat at the exact same rate for the last couple of months now, 3 months or so. Base rate 5.25. That's sat the same for a while now. The next date for your diary is the 21st of this month, 21st of March. That's when the Monetary Policy Committee will be sitting down and reviewing what to do next. I think the bigger picture is we're up for more stability for the rest of this year. With the elections taking place in the UK and the US, a lot of the sort of politics and things, and any of the messaging is generally being massaged out there. So more stability to come, I expect. That said, even the best economists can't predict the market, so take that with a pinch of salt, please. From our platform's perspective, January saw a peak month for us in terms of active advisors, product searches, unique advisors, which is all great. However, what's materializing into business off the back of that isn't so much. So that tells us there is a lot of engagement going on, client engagement. There's a lot of broker intent, trying to find products. Perhaps rates are still perceived as being high. I know they're not in the grand scheme of things. Perhaps products are not quite where they need to be. There's still a lot more innovation we can do. But that said, we are seeing a lot of innovation, and who better to talk through some of the innovation than Sanjay in just a few seconds' time. Rate increases and decreases seem to be here and there at the moment, kind of balance each other out. We're not moving in any particular direction. And then when I look at the larger picture of online searches, so Google searches and any other search engines that you might use, there is still significant searches in and around equity release, lifetime mortgages and retirement lending solutions. If you're interested to find any of those stats and figures out, a website called Ask the Public is really, really interesting to find out the volume of searches that are happening. But without further ado, that's enough from me. This is very much a platform for Sanjay to talk through the amazing product, which is Horizon Interest Rewards. It's all about providing a bespoke product to your client. It's about potentially saving them significant amounts of money. And as we all probably collectively agree, it's about generating amazing customer outcomes. So Sanjay, over to yourself. Good sir.
Thank you very much, Daniel, and good morning all. Thank you for your time today. As Daniel said, we're here to support you with our latest product enhancement, Horizon Interest Reward. So for those of you that don't know me, my name is Sanjay Gadhia. I'm National Sales Manager at Standard Life and Finance. And please feel free to jot down my details there. I'm sure we'll follow up with details hereafter too. So Horizon Interest Reward, just a bit of background really in terms of why we've brought this enhancement to the market. So it goes without saying, I really don't want to dwell on it too much, but 2023, the end customer really faced a significant increase in their rates compared to the previous two years. And I mean, arguably, in my opinion, that 18 to 24 month period prior to the mini budget back into 22, I think as an industry, we were quite spoilt. But we found that where customers were taking out lifetime mortgages, and particularly when they have family or beneficiaries, there was more of a request or a desire to, in effect, support that roll-up effect and make some form of repayments. And touching on the impact on the rates that the customers have faced and continue to face, it's that roll-up effect that occurs on the total cost of borrowing, notwithstanding the broader borrowing commitments that we all have all faced, with the increase in cost of energy, foods, goods. My local petrol station just keeps going up a penny every day. I'm trying to figure out why, but let's see what the budget brings when it comes this week. And lastly, really, when we were doing research with respect to this enhancement, we looked at customer profiles more akin to affordability. And when we looked at both ends of the spectrum, those that either did not or could not have the appetite or ability to service any of the lifetime mortgage, and compared that to the top end, where customers had the ability to service the capital and interest, arguably perhaps not a lifetime mortgage customer. It's really that spectrum in between of customers that had an ability to make some form of repayments. And that gap there actually widened quite significantly. And for ourselves at Standard Life and Finance, it gave us an opportunity to bring Horizon Interest Reward to the market. So who do we think that this enhancement could support by way of customers? So your first customer profile could be those that are your existing traditional lifetime mortgage customers, and rather than committing to monthly payments, they're opting for that voluntary optional payments that all lenders that have ERC approved plans must provide you and your customers. But in return, as opposed to really utilizing the optional voluntary repayment route, if they were to commit to monthly payments for a distinct term, we will be able to support them by offering them a discounted rate for the duration of the lifetime mortgage. And the second customer profile we've outlined here are those that potentially hold an existing residential mortgage, and the loan to values fit what we're currently offering on our Horizon range. However, and I go back to those broader borrowing commitments, they're either unable or unwilling to fully service their existing mortgage, not just the broader borrowing commitments, but the significant increase in rates that they've faced on their residential market too. I, for one, can speak about that because I just came out of a 5-year fixed end of Jan. Just going to leave it there. But yeah, I certainly feel the impact that those of lifetime mortgage customer age feel too. So these are two customer profiles where interest reward could be suitable. Those where interest reward is not suitable for are those that are looking for a drawdown. Horizon Interest Reward is only available on a lump sum basis. So if you have customers that have a desire to utilize the reserve facility, typically to sort of provide them income on a regular basis, then please discount Horizon Interest Reward. It's not one for them. Let's cut to the chase. I guess this is why you're all here. How does Horizon Interest Reward work? So as I mentioned, this is currently available on our Horizon lump sum and our fee-free range only, because we have a fee paid rate too. And for now, it is from a Horizon 300 plan upwards. And in the next few slides, I'll outline what the LTV parameters are. Now, this table on the right really quite simply demonstrates how interest reward is applied to our lifetime mortgage customers. So if I look at the lower end of the scale, it's a customer that can commit to servicing 50% of the interest each month and they commit to a term of 5 years. Now, providing they meet those monthly commitments, those 60 monthly payments, we're going to discount their headline rate by 5 bips. And as long as they make those 60 payments in this example, that 5 bip discount is going to remain for the duration of the lifetime mortgage. You can see all the other iterations based on customers that could service 75 or 100% and the 10 to 15 year terms. So if I focus on the two ends of this scale, a customer that can commit to 100% of the interest element for our longest term of 15 years, we're going to give them a 45 bip reduction. And as I mentioned, providing that customer makes those payments for that 15-year term, that 45 bip reduction will remain in place for the duration of their lifetime mortgage until they redeem their loan. Now, in addition, and this is absolutely one of our USPs, it's those optional voluntary repayments. Now, for ourselves at Standard Life Home Finance, we allow your customers to make up to 10% of the initial loan each policy anniversary without incurring any ERCs. And what I can kindly inform you of today is that facility there for your customers, that commences from day one. So if you've got customers that are happy to service the interest, in addition to that, if they have the appetite and the ability, they can add optional voluntary repayments, as I mentioned, up to 10% of the initial loan, in addition to the servicing the interest without incurring any ERCs. And subsequently, they will, in effect, just reduce that loan even more. So let me talk you through an example, if I may. We've got a customer here who is age 71, property value of 286,000, and this customer is releasing a loan of £65,780. Now, for the purpose of this example, we're assuming a term with respect to the cost of borrowing of being 20 years. Now, on this first row here, we're showing a customer that is not making any form of committed payments nor voluntary repayments. And the rate we've displayed here is 598 MER. So what we're really displaying is that roll-up effect of that 65,780 amounts to just over 216,000 after that 20-year term. But if you have a customer here that can service 50% of the interest for 5 years, you can see that we've dropped that rate by 5 bips. So the rate that's going to be applied is 5.93 monthly. That's the monthly payment amount and the term of 5 years. And what you can demonstrate here is the impact of those monthly savings or the monthly payments, reducing that total cost of borrowing over that 20-year term by £34,318. That's your value add as an advisor in terms of supporting that customer that has the ability and appetite and sort of emphasizing the saving they can make. And lastly, a customer that can service 100% of the interest for our longest term of 15 years. You've got that lovely 45 bit discount there. That leaves a 5-year roll up in my example with a 20-year term. So that's the cost of borrowing after 20 years, just over £82,000. So let's go into a bit more detail about payments and inform you all about what happens. What's the risk? I've probably sold you a dream. There is a downfall. So payments will be collected via standing order, and we would expect that customer to make that first payment 1 month post completion. Now, we absolutely acknowledge and recognize that customers may miss payments. In saying so, customers are able to miss payments, and it's up to the value of 3 monthly payments, and we will not remove that discount. However, if that payment shortfall goes over the value of 3 months, even just by a penny, the negative side to interest reward is that your customer is going to revert back to that non-discounted rate. Now, there's 2 things that will come into play in this instance. What rate will be applied? So the rate that will be applied is the rate at point of completion. And for yourselves and your customers, these rates are all outlined on our KFI and offer documents. So that's the rate that will be applied. When will it be applied? That non-discounted rate will be applied at point that they miss or go over the value of 3 monthly payments, even if it's just by a penny. Now, in order to keep that discount, we ask your customers to make up that shortfall, ideally during the term, or if not, we are able to extend that term out by up to 3 months should we need to. If I just play this out into an example, let's say, for example, your customer may miss 2 months worth of payments and therefore 2 months of value of payments in the first year. But by the end of year one, that customer is able to make up that shortfall. So in effect, their balance, or by way of the interest element, is a net zero. In year two, for one reason or another, that customer then starts, he or she misses 3 months worth of value of payments, provided they don't go over that by a penny, and they make up that shortfall. Again, they will keep that discount. So it's only if they miss up to 3 months of value plus a penny. Now, if your customer was, for whatever reason, saying that they cannot no longer sustain those committed payments, we're still going to allow your customer to make those optional voluntary repayments. And furthermore, that's up to 10% of the initial loan without incurring any ERCs. So we're trying to keep this as simple as possible. If you've seen our plans and you've recommended us to your customers already, we're still providing you with our market leading features. I absolutely love these. A fixed ERC, really low, only at 8 years. We were one of the lowest in the market. I know there's a plan out there that offers a lower ERC than 8, and I know there's a couple of lenders at 8 years too. However, fixed ERCs for 8 years, just as a reminder, that starts at 8% in year one and simply reduces 1% each year. Therefore, in year 8, your customer would incur a 1% ERC amount, and from year 9, your customer's ERC free. Downsizing protection, again, I just want to give you a quick refresher on these, if I may. It's available from day one with ourselves, and how it's triggered is if your customer was to purchase a property in the future, and at that point in time, said property does not meet our underwriting criteria, then in effect, they can utilize downsizing protection and they can settle our plan ERC free. The second trigger for downsizing protection is if your customers opt to move abroad. ERC exemption, if you've seen me on socials already, I am absolutely in love with this feature. I think especially when you've got joint applications. So the ERC exemption, widely known as a bereavement or a compassionate clause, triggered on one of two life events, be it one applicant sadly passes away or ends up residing in long-term care. You're used to commonly a 3-year ERC free window with other lenders. Standard Life Home Finance give your customers an unrestricted ERC free window. Therefore, in effect, if one of those two life events were to sadly occur at any point in that lifetime mortgage, or crucially within that 8-year period, just assume your customer is ERC free for the duration of the lifetime mortgage plan. And if I haven't said it once or twice, I've said it about 5 times already, it's those partial repayments. So we still allow your customers to make up to 10% of the initial loan per policy anniversary without incurring any early repayment charges. So if I just go back to the product perimeters, I mentioned to you earlier that this starts from our Horizon 300 plan, and it's our lump sum and our fee-free range only. So this outlines what our LTVs are for these customers and based on their ages. So starting LTV is 8%. For couples, it stops out on our Horizon 600 range. So the max LTV for a couple is 50%. And for a single applicant, as of today, a Horizon 620 plan can give your customer up to 51% loan to value. Product perimeters and loan amounts are all exactly the same as our existing Horizon range. So 99k up to 5.1 mil on the property, 10k up to 1.5 mil on the loan amount too. Now, if you deal with customers who are deemed as high net worth, where the property value and or the loan amount may exceed our product perimeters, whilst respecting that we may not appear on sourcing, please don't rule us out. If you've seen our rates, particularly since the end of January, I'm really pleased to see that Phoenix's appetite has certainly widened, and they have the appetite to consider customers where the product perimeters are exceeded or breach those limits. And lastly, just as a reminder, customers' age of entry, minimum 55, as it would be for a lifetime mortgage plan, and that maximum customer age, it's on that youngest applicant, so they must be just under the age of 85, and that's at point of application. So for instance, if you have a customer or a couple, for instance, who are, say, aged 91 and 84, but the 84-year-old's birthday is coming up next week, providing you submit the application to us prior to that birthday taking place, we will allow that to go through all the way through to completion even if that customer turns 85 whilst we're processing the application. That's me over, ladies and gents. I'm going to keep the slides on, if I may, just for a few minutes. I can see there's some stuff come on the chat too, which I'll open up. But if I can just keep the slides open in case any of you wish to me revert back to any of the slides and go over any detail that you require.
Brilliant, Sanjay. Loads of notes there, and I'm sure everybody has made some notes too. I guess just whilst we're waiting for any verbal questions, we could have a little look through the chat and go through some of those questions if we can. So I'll read them out for you. So Merrill, really appreciate your question. I think we might have answered it after you'd posted that, but are the rates fixed? So Sanj, just a little bit on that, and then we'll go through the rest.
Yeah, sure. And thank you, Merrill, for your inquiry. Absolutely. I mean, I was going to start off with my opening gambit, which is Horizon Interest Reward. This product enhancement is Equity Release Council approved. And therefore, from your end customer's perspective, they are protected by the standards that we must abide by. And the two I'm going to call out is, your customer has that no negative equity guarantee protection and no risk of losing tenure. So, yeah, it's a lifetime mortgage plan, and all our rates are fixed, Merrill, just to answer that query for you.
Yeah. And I guess the second part of the question was, can you make voluntary payments? And I think we've boxed that one off as well with the standards. So yes from that one. But really appreciate the questions. Brian, question from you, Brian Kasky. I don't know if I've had a webinar where somebody's not asked this question, to be fair, but obviously it's an area where lenders possibly could further look into. But will you consider any property that has been insulated with spray foam in the loft? There's obviously quite a few of these still around.
Yeah, there is. I just recorded at a moment in time where the government were handing out grants and going to those of lifetime mortgage age and above, and offering them this. But in short, Brian, sadly, the answer is no. There was some moments when quite a lot of lenders were considering it, providing it was removed, but I think that's reduced quite drastically. I think some lenders will consider it, but Brian, for us at Standard Life and Finance at present, we're not able to consider properties with spray foam. Just to give you a bit of context, if I may, on that, really, I think it's a lack of experience that lenders and funders have with spray foam, and I think the experience that they've had to date is that spray foam actually often does more damage to the roof than it does protect it. Particularly when you're looking at our sort of products and solutions that we offer. We're looking at having properties on our assets and our books for circa 15 to 25 years, and there's just not enough experience or comfort from Phoenix's perspective to reopen that and open up its criteria. But yeah, we'll keep banging that drum, and you never know, they may change their minds, but nothing in the short term.
Yeah, and I know it's frustrating from an advisor's perspective because it feels like every other client has had spray foam or an element of spray foam, is willing to get it removed, and even then that there's obviously challenges. But we really appreciate your question nonetheless. I wanted to ask this question as well, Jason, but you beat me to it, mate, so thank you for that. So Jason Lloyd's got a question. Is there any affordability assessment, and if so, are there any form of calculators on the website to help cover that?
Yeah, so Jason, with respect to the affordability assessment piece, we would expect that to form part of your advice process by way of understanding what non-disposable income your customers have. But for ourselves as a lender, given the fact that we've got the protections from the Equity Release Council, we don't require to have any sight or evidence of said income. And the reason for that, if I just extend it out a bit more, is the fact that the downside of our Horizon Interest Reward plan is that they will revert back to a non-discounted rate. So that's the risk that's associated to it. And secondary on that one, with regards to whether there's an online calculator that we can use, I've got Jenna on as well. I don't want to call her out on this one, but I want to say for now there isn't anything at present available on our site. Daniel, I'm not too sure. Is there something from AdviceWise that advisors can use to support them?
I think definitely from, just to plug other sourcing systems as well, we want to add value here. There are tools out there, not just in the later life space, I will add, that help you understand income and affordability. There are lots of resources, appreciating if anybody on the call is solely maybe a newer advisor or maybe a specialist advisor that hasn't had to go into so much detail when it comes to income and affordability. There's lots of support out there from a lot of mortgage companies when it comes to budget planners and what's classed and deemed as income and affordability, even other lenders that maybe operate in the REO space that we might be familiar with. There's support and guidance there. We are working on things in the background. I think we'd be silly not to. We have got something designed up, but there's a lot of moving parts, right? And we need to work with some of these some credible residential counterparts that operate specifically in this area. But as Sanjay rightly said, because it will automatically fall back onto what would be deemed a lifetime rate that we know and love, there's no real issue from a lender's perspective. But yeah, hopefully that's a long way around your question.
Yeah, and Jason, we'll take that away from our side as well. Jellen might be kicking me, probably telling me there's something already available, and I've just completely missed it. But no, absolutely valid question, Jason. One we'll play back to Daniel as well and keep you updated on.
What I've seen with other lenders with maybe similar propositions in this market and out of this market is case studies are really, really powerful. So I know you want to specifically give your client and the KFI, the site of the KFI, don't get me wrong, will be incredibly valuable. I'm sure Sanjay's got that covered. But bringing case studies to your client, as Sanjay loosely touched on there, showing them the real impact. So to take a loan of, I think it was 64 grand and over 20 years, so there's only 5 years of that's actually accrued interest, it only be 80 odd grand after that. I think that's incredibly strong. And then if you add on to that all of those consumer protections that we know very well and are familiar with, and in some respects, things like your downsizing protection are far more favourable than other lenders in the sector. So yeah, really, really impressed with that innovation. And then I guess at a higher level, we're seeing lots of these sorts of payment term mandatory payments. Remember, this isn't mandatory. This is optional. This is a discount, and this is much more simplified. So yeah, there's probably a little bit more learning we need to do, and I'm sure Sanjay will say engage with the sales team and himself to further enhance your understanding.
Absolutely.
Just looking at some of the other questions, I might have covered one of them while I was speaking there about the KFI. Does the 10% voluntary payments affect the amount of interest being paid and accrued during the contractual period? So I think what we're asking there from Charles, thanks for that, Charles, is I pay off the full 10% option allowance in year 1, 2, 3, and 4. Does that affect the interest, or is that interest going to be based off of the initial loan minus?
Yeah, Charles, thank you for that question. I really appreciate it. So, in short, we've got to see these as two different things. So, the monthly amount that the customer is paying us is going to remain the same, even if your customer makes those optional voluntary repayments. What we'll be doing behind the scenes, mind, Charles, is we acknowledge and respect that, say, for example, the example I'm playing out is if we have a customer that takes out a loan of £100,000, and let's say, for instance, the interest that's being applied per month is £100. And at the end of year 1, your customer drops a 10% voluntary repayment and in effect making that loan 90,000. What we'll be doing in the background is in year 2, we're still going to ask your customer to make those £100 payments each month. However, if the true interest that needs to be applied because that loan's reduced, and let's say that true interest rate or the interest amount, is £90 instead of the 100, we will still take the £100 from the customer. We'll be applying £90 of that to the interest element. And in my example, this is where a customer is servicing 100%. And that surplus, again, in my example, which is £10, we're going to actually put that back into the initial loan to reduce it further. And in doing so, that still does not impact the ability for your customer to make the additional 10% in year 2 and thereafter. But so that example there is £100 is the committed payment that your customer goes for in year 1. In year 2, after making that 10% payment, the true interest that should be applied because the loan's reduced by 10k is £90. We'll put that surplus £10 back into the loan. Now, if your customers were to service, say, 75 or 50% of the interest, but they opt to drop in some optional voluntary repayments, where there is any surplus, we will be applying that to the rest of the interest first before we start eroding any capital thereafter. So in short, and apologies, Daniel, for interrupting you.
That's right.
In that example there of 100k, I guess your normal maths for someone that was going to be servicing 100% of the interest, you'd think really easily that customer can clear that loan off in 10 years if they were to make the 10k additional voluntary repayments in year 2. But actually, because we've got that surplus being put back into the loan, I've seen an example where that loan could be paid off in 8 years from 4 months.
Yeah, that's really powerful stuff. So just to re-clarify, and if I'm thinking it, I'm sure people on the call will be thinking it. So in year two, you've paid your £100, you've possibly paid a little bit more that's eroded some of the capital. Is that extra payment that's eroding the capital, is that using up your 10% allowance, or is that in addition to? So what my question might be there, would the client find themselves in an instance perhaps where they've been really keen on payments, paying an ERC, going over the 10% allowance on top of that? So it's in addition, did you say?
It is in addition, yes.
Yeah. Yeah. Awesome. I think that's really flexible, and that's obviously great from a client's perspective. And I guess remember, for everyone on this call, that this is new space for you and the team, I'm sure. And this is very much MVP, first iteration, and I'm sure it will improve tenfold as we get more confidence and we start to see some clients come through on it. So
Watch this
great,
space.
great stuff.
Watch this space.
Sounds like you've already got plans.
Oh,
Another question from Merrill here. So if it reverts to a non-discounted rate, so clients stop payments, or perhaps they've gone over the 3-month period where they've not been able to make payments, it revert back to the standard, the interest rate it was on the outset of advice or completion. Does that mean that, sorry, I'm turning my head sideways because my friend's on its side, that it reverts to a standard ER with a right to remain in the property?
yeah, Merrill, absolutely. I mean, in fact, I'm quite pleased I've got this slide available or on screen. So let's say, for example, so the rate, assuming that the customer is not making any form of committed payments, that rate's 598. Let's say that they opted for that 100% 15 years and stopped for whatever reason, they would revert back to this 598 rate. But as I mentioned, Merrill, this plan is Equity Release Council approved. So your customers are still protected by the standards that we abide by. So again, they are never going to be at risk of losing their home. It will just revert back to a traditional lifetime mortgage plan, and the interest will roll up. But if they have, they've still got that optional voluntary repayments thereafter.
Yeah, and I think that what we need to constantly remind ourselves, it will always go down to or default back to a standard plan that we know, and that's made it incredibly easy for, say, the Equity Release Council to categorize this product because there are no mandatory repayments. Question for you, and I know every lender treats this slightly different. This one's from me. Would you ever open up the remit to do, say, a direct debit where you're pulling the payment as opposed? Because the reason why a lot of lenders don't do direct debits, just for context for everybody, is because this is a product set where payments are not mandatory. So a standing order puts the power in the consumer's hands to make that payment. Now, probably from an advisor's perspective, you probably think, well, surely it's better to set up payments on outset. If the lender sets up a direct debit, then they can set it and forget it, and it's probably going to be in line with the advice. It's easy for a client to possibly cancel or stop a standing order. Any views there? Any comments there?
Yeah, absolutely, Daniel. And unsurprisingly, this is not the first time I've been asked. And yes, we do have a desire to create direct debits in the future. So this kind of came to fruition towards the second half of last year. And as with everything that we want to do, we want to get it out to market quite quickly. So for sort of MVP, we've come out with a standing order option, but we are going to be looking into direct debits in the future.
Mm-hmm. Okay, awesome. And I don't see that as a bad thing. I think it still very much puts the power in the consumer's hands, but it just gives you future flexibility, I'm sure. Great stuff. Just checking the chat box. I think, Brian, I think we might have answered that section. So the 100,000 would drop to 50,000. You would still pay the full amount. So Sanjay was saying, yeah, you'd still commit to the £100 per month in that example, and any surplus would be eroding some of that capital. Positive. Any more? Any more questions? Does anybody want to unmute and possibly ask a question? Mix it up a little bit. I think it's quite good when we get a bit of a range of questions. Nope, seems to be all quiet on the Western
I'll ask
Front.
one, Daniel, actually. It was because we've had this before with Sanjay anyway, so I'll ask the same question, which hasn't been brought up as of yet. If somebody does make the standard monthly payments, but then makes overpayments as well, but then in future years they fail to make payments, is the overpayments going to prevent it from reverting back to the other rate?
Yeah, I understand the question, Tim, and yeah, thank you for that. Really, so yeah, I guess it is in the instance where customers make it. So if I've understood that, Tim, optional. So monthly committed payments come in. Optional voluntary repayments have been made, say in year one, and that's eroding the capital or the capital element of the lifetime mortgage. In year two, customer may miss 2 months worth of value of payments. Is the answer, Tim? can we dip into that pot that was the optional voluntary payment to support the missed payments element? Would that be right? Yeah. Yeah, perfect. Yeah. In short, the answer is no, sadly, Tim, on that one. So we treat them as two separate payments. So the monthly element and the value of those missed payments or non-missed payments will be there. Any optional payments, because that's eating to the loan as opposed to the interest element, we're not going to be able to take it from one pot to support the shortfall on the other.
That's almost like I might be wrong on the terminology, but like a reverse mortgage, like we would all have. That I'm sure there's been providers. I don't think there's any at the moment that would do that in resi space. That would be nice to have that flexibility, though. But
Yes.
I think it's simple is probably the better option at the moment when we're testing these type of plans. Yeah.
Yep.
Good question, though, Tim.
I appreciate it. Thank you so much.
Stuff. Sanjay, has there been any questions that you've had on other sessions that you think would provide a valuable answer to people on the call? So not necessarily questions from this call, but has anybody else questioned you and you're like, oh,
there has
I
been.
didn't think of that.
There's one I'm going to call out really where, and some advisors may be thinking this, if I focus on the 100% interest payment, and you can see the rate differential, the rate discounts that are available based on 5, 10 and 15 years. So, instantly eyes on the prize, a nice 0.45% discount. Why not just put a customer into a 15-year term where the advisor and customer may know full well that they cannot make payments after year 5. So they benefit from a 45 bit reduction for the first 5 years and then stop making payments and therefore revert back to the non-discounted rate. Now, in that instance there, what I would certainly suggest is please carry out 2 KFIs to show your customer the impact of the roll-up when that customer stops making payments. So, for example, if your customer was to commit to a 15-year term and 100% interest, they have that 45 bip discount, and on a 5-year, it's 15 bips. Now, providing if your customer was to opt for that 5-year term, just as a reminder that 15 bip reduction in this example will continue for the duration of the lifetime mortgage. However, if your customers commit to 15 years and stop after 5, they're going to have an added 30 bips onto their rate that they were used to for the first 5 years, and that roll up is significantly higher. And we're working on some sales assets to support you and your customers with just understanding the risk of potentially going for 15 years, knowing that the 5-year option is one that your customer is more comfortable with, and that the impact on the roll up with that non-discounted rate for that additional 10 years can be quite significant. A couple of figures that we're due to bring out shows that your customer is net up circa £3,000 to £6,000 over a 20-year term if they opt for the 5-year option and only go for that 15 bip reduction, as opposed to going for the 15 years at 45 bips and stopping after 5. That's a lot of words there. I really hope that example and the understandings come through.
Yeah, no, it does definitely, and there's definitely mileage that they wouldn't be developing these products if they didn't see fit in the space, right? So typically with a Rio provider, a lot of people fall down on affordability and income because there is a structured stress test and test for that. Obviously, with these products, there isn't, and it has the fallback of default into what we know.
I'm really pleased you said that, actually, because even for myself, what I've been really excited about with interest reward is we're now playing into that space where we've got advisors comparing, especially where we've got quite aggressive rates at the moment. And when you add to that discount, we are getting advisors considering an interest serve plan versus a Rio for a few reasons, really. It's as you mentioned, the stress test, the protection that the customer has on a lifetime mortgage versus a Rio too. So it's been exciting because it's put me into a new world too.
Good. And I hope you all on the call have seen this all over sourcing, because I certainly have. It seems like, as you say, there's a massive funding appetite from Phoenix and Standard Life Home Finance. So it's great to see that. Just out of curiosity, for anybody on the call, has anybody recently, I know this is a very new plan, but has anybody recently engaged on this plan or perhaps started the process of getting towards a recommendation? Could anybody possibly share their experience? And that might even tail off for some questions as well, where they might have struggled, because it's going to become up where it's your first time recommending this plan at some point, and it's an opportunity to talk about it with peers. So any questions from the room, feel free to unmute yourself if you have. If you haven't, then fine. I'm sure you go and do sourcing this afternoon. You will see it at the top of sourcing, because it's great to have that headline rate 5.38. I think it was, if my mind serves me right.
Yeah, that's on our 200 range. Yeah, so our lifetime mortgage is headlining right now on 538. Our headline rate on the Horizon Interest Reward Plan as of today, caveat 6th of March 24, is 589 MER. So you could get a customer, if they are able to commit to 15 years, 100%, it's 544 monthly.
Yeah, and a discount of nearly, or 45 bips, wasn't it? It was nearly 0.5%. That's crazy.
Yeah.
Any more from the room? Just checking the chat. No. If not, I'll just go through some of my learning points, I guess, and I guess to reaffirm, because it's always good to share what I've learned, and hopefully some of you guys on the call, and Sanjay, same for yourself, if you want to reaffirm the key salient points from your session. But for me, it's it's from Horizon 300 upwards. It's lump sum only. The commitment can be from as little as 5 years all the way up to 15 years, and that discount is from 0.05 bips all the way up to 0.45 bips, and that's crazy. You get the addition of optional repayments and all of the amazing consumer protections that we are very familiar with. And if it's fair to say, some of your consumer protection points outweigh some of the lenders in the sector too, so more favorable in terms of consumers. I've just seen another question come through. Let's just have a little nosy at that, because it's always good to go through. Are you looking to change for family members being able to make the monthly payments?
Jeremy, a great question too. So we can we at present, we can allow family members to make payments. However, we do require it to go via the applicant's account. So in these examples, Jeremy, what we suggest is, if typically it's children, and naturally, why not? If they have the ability and appetite to service the interest on behalf of, say, mum or dad, if they were to create a standing order that goes into the parent's account a few days before we collect it, then that's the way that we can support a family member servicing it instead of the applicants themselves.
Mm-hmm. But it's good to see that those are conversations happening. I mean, speaking candidly, how many children or grandchildren will be wanting to make payments? I know it makes sense on paper, but it's good to see that those conversations are taking place.
Yeah. Excellent. Thank you, Jeremy.
Amazing. Thank you very much, Jeremy. Brilliant. Any more? If not, over to Sanjay just to close, if you want to close.
Meryl just called another one out about, can we do a further advance with this product? And the answer to that is yes, Meryl. We'll consider those on a case-by-case basis, but at present, we're not restricting customers to do further advances.
Okay, good question. I like it. Awesome. Well, yeah, Sanjay, do you have any other additional points to add?
No, I think you covered off all the bases really, and summarised it quite nicely for me, Daniel. So thank you for doing so. But yeah, again, if I was to really strip this plan back to its bare bones, it is a lifetime mortgage, giving the customers the ability to, when they can commit to monthly payments, to be rewarded by a discounted rate for the duration of the lifetime mortgage. Apart from that, all of the other wonderful things that we offer on our lifetime mortgage range all stand true. It's just the added ability to make payments in return for a discounted rate for life.
Good stuff. And that very last question from Jeremy, from my perspective, I think the biggest difference is one's mandatory, one's not.
Correct.
Right?
Yeah. So I think there's twofold here, really. I think with the great innovation from the likes of LGHF and other lenders that are coming into that space, is we're playing on a rate discount for your customer, where I believe where these other plans are going with the what they call payment term, that abbreviation, Daniel, words escape me.
PTLM, I think it's called now.
PTLM, yeah, I couldn't remember what that meant. That, I think, in essence, is trying to increase the loan to value for the customers as opposed to offering them a discounted rate. So, yeah, slightly different space. And as Daniel quite rightly pointed out, committed versus contractual. Good
stuff. I'm loving these questions, by the way. As you could tell, we're slowly wrapping up, coming towards the end of the year, but we just had a flurry of questions. So we absolutely have time to cover these. So, in terms of Meryl's questions, what if the client can't afford 50% of the interest?
Yeah. Sorry, Daniel. No, I think with this one here, Meryl, it's more around if they don't have the ability or appetite to make 50% of the interest, you probably want to just revert them back to our traditional lifetime mortgage range, and that customer can still make those optional voluntary repayments, so they can still service their loan. But that potentially opens them up more to the whole space where all lenders give your customer that option there.
Good stuff. Yeah, and absolutely right, Jeremy, that the product is very flexible. So We'll pay that one later, Joe.
Yeah, exactly. I was thinking the same.
Thank you. Just, well, we have still got 15 minutes, and if the questions do quieten down, I'm happy to sort of close off the session. But yeah, last call for questions from my perspective, and then we will finish the recording and we'll close up formally. Awesome. Great. Okay. Well, if there isn't any questions, I'll wrap up. Just from me and AdviseWise, team AdviseWise, massive thank you to Sanjay and team Standard Life Home Finance for joining us. It's great to see Jenna in the background on the call as well. I know we didn't put her on the spotlight for anything there, but it's great to see some of the team supporting you. From our perspective, I mentioned at the start, this has been recorded. You will receive your follow-up email. Probably not today. It'll probably be by the end of the week. It'll be a follow-up email with a link to request your CPD certificate, and obviously a link to perhaps watch this and many more sessions back retrospectively. We have got some other sessions coming up on the 21st of March. We've got a marketing specific webinar coming on. That's going to be really interesting. So I'm seeing more and more people get into the space of building an online brand, making sure that they are perhaps resonating with the clients effectively, putting the right content out to perhaps the over 50s demographic. So Rachel Pease from Mash Marketing will be talking us through effective later life marketing. So a contact that we're familiar with in the sector, Sanjay, I'm sure. If you're not using us already, please have a little check it out, log in, see what's new, perhaps even book a demo with myself or Tim. We'll be more than happy to take you through in a live environment. But yeah, that's everything from me. Thank you to you guys as delegates for joining. You do make the session. The questions really do help the engagement and deepen the learning for everybody getting involved. So yeah, massive thank you. But that is everything. Have a great Wednesday. I'm going to hang around on the call, Sanj. I think we'll stop the recording and we'll go from there.
Perfect. Yep. Thank you for having me.
Thank you, guys.
And AdviseWise. Have a good day all. Thanks for attending.